Hey everyone, thank you very much for joining me for part two, in which I'm using frugal velocity banking techniques to reduce my overall debt and overall improve the amount of money that's going toward the principal to pay down one of two HELOCs or lines of credit. Let's go ahead and get started. All right, in the video one, what I basically showed that I have about 15 grand in some credit card debt, not all my credit card debt, but just going to use this amount. The monthly payments 316.96, the interest 255.54, and I have a HELOC with a $100,000 limit. Currently has 33,636.54 on it. I showed how I'm looking to consolidate this debt in general. So let's go ahead and get into part two. So part two, I consolidated that 15,000 and that 33,000, and it gave me a total of $694.24 and interest payments of 622.41. Now, this is coming from the top here from my credit card and HELOC payments from December of 2025. So let me go ahead and put that here. And I've taken these payments and interest. So prior to the consolidation, if we look in this box here, the current monthly payment would have been 694.24 if I were to consolidate all the debt, the HELOC and the credit line. The current interest between the HELOC and all the credit cards would have been $622.41. So by me just paying that current payment, which was the minimum payments, and then the current interest from the credit cards and the HELOC, that would have been a total of $71.83 going toward principal reduction. This was before the consolidation. Now, if we move over here to the post consolidation, let me make this a little bit bigger. You can see that the limit on the credit card, the limit on the HELOC is 100,000. The total that I will be putting on it will be $48,662.72. The interest rate on that amount will be $397.97. So this is an interest only HELOC line of credit for 20 years. I can pay the interest only. Then the second would be the interest and principal payment reduction, which could be considered like a regular mortgage payment. But for at least the first 20 years, I can pay it interest only and tackle some other debt. Now, in looking at the difference between the pre and post consolidation interest, that is, I was paying $622.41 in the month of December charges. And if I consolidate it, the difference, it'll be 399, and that'll give us a difference of $222.44. That's just in the interest. Now, the difference between the post-consolidation payment and pre-consolidation payment, in the pre-consolidation payment would have been $694 for everything, the HELOC and all nine credit cards. And if I come over here, where still the monthly payment could be $399.99 because remember, I'm paying only the interest only at 10%. I'm not paying anything toward the principal. So the difference between the current December payments of everything and when I switch it over to a HELOC, hypothetically, it would have been $399.97, interest only. And the difference between 694 and 399, $294.27. Now, should I do that? I'm gonna make one more diagram. Let's do this to make it a little clear. So Post consolidation, let me put that here, post consolidation, the monthly payment is $694, and when I consolidate it post, $399.97. The difference is $294. Change this to payment. And then turn that to pre-month payment and post-month payment. And the difference is $294. So before I consolidated the payments from December credit card interest and payments, $71.83 was going toward the principal with all the credit cards and their various interest rates. Now I consolidated it under a 10% interest rate. And from 694, which was the pre-month payment, to now 399 being the post-month payment. But I want to really pay off the HELOC down to zero. I hadn't calculated the number of months. But rather than just paying the interest, I'm going to continue to put the interest and the principal reduction together, which would equal 694. And here that is. So my new payment, I'm going to stay with the 694 from December, which would include the 399 that's going to be calculated on the interest and the 294, which would be the principal reduction between what used to be $71.83 and now 294. And well, let's go ahead and create another one. And I'm gonna call this the principal reduction difference. And that's between pre and post consolidation. Principal reduction difference. And that would be taking the $71, 71.83, and putting the 294, which is now increased principal reduction. So now I have an extra $222.44 going toward the principal reduction. Now, so far, with the Federal Reserve reducing the interest rates, the HELOC has come down, but it can go up. The HELOC has a floor of, I think, my HELOC 399, the lowest interest rate, and 18%. Now, I'm still willing to pay the 18% interest on the HELOC because I previously consolidated all of my debt in 2025, and I was paying about 25 or 26% interest across the board. So even if this rise against me to 18%, I'm still coming out cheaper than what initially I was paying before I started this HELOC journey. So just to sum it up, initially I was paying December. Let's go back. Initially, I was paying had a total of $15,000 balance, $36,000 balance on the HELOC. I combined it, and I'm looking at an interest rate combined. And this is what the pre-consolidation, post-consolidation, and there was a principal reduction of $71.83. That was in December. But then upon consolidating the debt under one with that 10% HELOC, my principal payment reduction was 294, and I subtracted what I was in the beginning and then the post. So now I have an additional $224.44 going toward the principal reduction. Now, again, it could change. If interest rate starts rising, this principal reduction amount can be less. But again, I'm still within a good period because even at 18% on my HELOC, I was paying about average 25% on all the credit cards. So I'm still in a good area. So thank you very much for stopping by and hopefully this journey of mine as I continue and utilize this extra as a principal reduction. Everybody have a great day. Bye-bye.